I'm going to buy silver. It's $100, $120, $200, $250, $600. Oh, I better buy it. But actually what's been happening is that the silver price has been managed by China. You've got this deficit, which quite correctly comes out of the Silver Institute's tables. That has been made up by China exporting silver. You could put it that China foresees a situation that's not prices rising, but the currencies falling, and she's indulging, if you like, in a central bank's version of a crackup boom. This was something that the economist Ludwig von Mises wrote about People's Bank, the SGE, have done. But bear in mind, the SGE is owned and run by the People's Banks. They weren't going to survive. So what she had to do was to play the fiat currency game, but never forget she needed to protect herself against their collapse. She's probably, as the state accumulated a further 20, maybe 25,000 tons into the hands of the public, that is a further 28,000 tons.
We seem to be stuck at around the $60 range since a fairly sharp drop in price from around 70 at the end of last month. Are you viewing this as a buying opportunity, a time to exercise caution? And what is your outlook for the silver market for the rest of 2026?
Well, silver is very volatile, and the only way to treat it is stack, 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 in my view. The price doesn't really matter in the sense that what I'm doing when I buy silver is I'm just getting rid of fiat currencies. That's the main thing. And trying to sort of guess where it's going and using charts and all this sort of stuff is not really the point. I'm pretty certain that once silver moves, and I don't know when that'll be. I mean, I've got opinions, but I can't do more than that. When it really moves, I know one thing for absolute certain: all those people who've been going on about, I'm going to buy silver, when I think it's right, well, they'll miss it, and then they'll be trying to catch their tails. You'll find it's $100, $120, $150. Oh, it's got to come back. I mean, it's going up too fast. It's got to come back, and then I'll buy it. $200, $250, $600. Oh, I better buy it. 10 times above where it is now. I mean, that's what happens. This is my experience of traders.
Markets look calm, but hesitation has historically punished late precious metals buyers more than volatility itself. As Alasdair Macleod points out here, waiting for perfect entry prices often becomes a psychological trap once momentum accelerates. The bigger risk is in temporary price swings but persistent erosion of purchasing power through weakening fiat currencies. Patient accumulation favors disciplined investors over emotional traders. Next, Alasdair Macleod exposes why the biggest silver rallies begin only after most investors convince themselves to wait.
Some traders get it right, okay, which is good, but they are a minority, and all this fooling around, trying to double guess markets and all the rest of it, it misses the point. What we're actually seeing is the death of fiat currencies. And in that case, I mean, you may as well go and buy copper, you could buy gold, you could buy oil, you could buy, anything that you can take delivery of, you should buy just to get the hell out of fiat currencies, because they're going to zero. But there will always be a need for silver, gold, copper, oil, whatever. So that's what you should own.
The Silver Institute projects the market will remain in structural deficit for a 6th straight year here in 2026, with MINS silver production expected to rise only modestly, around 1%, according to some forecasts. Surely we're reaching the point where the physical supply-demand imbalance has to trump paper speculation. Would you agree with that?
Yeah, I think you've got to, people have got to understand actually what's been happening with silver. The Silver Institute is right. I mean, you can draw up supply, demand, surplus deficit type charts as much as you like. But actually what's been happening is that the silver price has been managed by China. China is it's the largest importer of the sources of silver, which are non-ferrous ores, particularly copper, zinc, to a lesser extent lead, and also gold. That's where it all comes from. I mean, what, over 70% of silver comes from that.
A sixth consecutive structural silver deficit should be headline news, yet institutional attention remains remarkably muted. According to Alasdair Macleod, supply-demand charts miss a larger force when state actors influence physical metal flows behind the scenes. Investors focusing only on paper prices may overlook where strategic inventories are actually moving. Physical ownership becomes increasingly relevant when official narratives diverge from underlying accumulation. Next, Alasdair Macleod reveals why China's silver strategy creates a contradiction that paper markets cannot explain.
And as a result, basically China has been accumulating huge amounts of silver for a very, very long time. It's part of official policy, not publicly declared. They don't go out and tell us this month we bought this month we refined so much, and that produced so many tons of silver. No, of course they don't. They don't tell us what's going on. But believe you me, the policy going back to 1983 has been to accumulate gold and silver. And the PBOC has total responsibility for the acquisition of gold and silver. Now, what's happened is that in the last however many years, when you've got this deficit, which quite correctly comes out of the Silver Institute's tables, that has been made up by China exporting silver to satisfy demand. Why? She's been keeping the price of silver under $50. So, and then this changed. This changed sometime, I would guess, in sort of late September, early October, probably late September, along with rare earths. I mean, the rare earth story had been brewing up for a little while, but quite clearly China was not going to export silver for America, which had then decided it was a critical mineral, to supply America. So what did she do? She reversed her policy. And we saw silver jump from $50 in sort of, I think it was sort of early October, all the way up to 120. And if you look at what China has done in the first quarter of this year, she has bought a total, I think the figure is 1,626 tons.
China's actions changed long before most investors noticed the price surge. What Alasdair Macleod is highlighting is that decades of strategic accumulation matter more than short-term market sentiment. If exports truly slowed while domestic buying accelerated, the official supply story becomes far less convincing. Investors should watch government behavior instead of headline explanations for volatility. Next, Alasdair Macleod unravels why China's import data contradicts the market's pricing narrative.
Now, we haven't been given any export figures because usually there's imports and exports. But for some reason, there hasn't been any export figures, if you like, issued. Now, this 1,626 tons annualized, we're looking at about 5,000 plus tons. Now, this, if you like, compares with the roughly 3,000 to 5,000 tons which China has been exporting every year recently to satisfy and to deal with that supply deficit in the West. So in other words, this is a completely volte-face. And it's fascinating that she has acquired all this silver at a time when we've been trying to get the hell out of it. I mean, this is part of a wider policy, actually, because at the same time, China has imported 163 tons of non-monetary gold. That was up to May. We haven't had June's figures yet. And on top of that, there's a further 40 tons recorded of non-monetary gold. So that's an addition to the 163. So around about 200 tons gold. And that's what's been reported. I mean, it could be, the truth very often in these things is somewhat different. So what's she doing? What's she doing with stockpiling copper? What's she doing sort of ceasing exports of things like fertilizers and sulfuric acid and so on. I mean, the answer to this, quite simply, is she doesn't want any dollars. Her trade surplus is now hitting records. So she's earning foreign currencies, which she knows are going to go to zero. She doesn't want them.
When a major trading nation prefers hard assets over surplus dollars, investors should pay close attention. Alasdair Macleod's argument suggests China's commodity stockpiling reflects long-term currency risk management rather than ordinary trade decisions. Whether or not every reported figure is precise, the direction of policy deserves scrutiny. Savers relying entirely on financial assets may be underestimating monetary risks. Next, Alasdair Macleod reveals why China's commodity purchases point toward a broader shift away from fiat reserves.
So if you like, you could put it that China foresees a situation that's not prices rising, but the currencies falling, and she's indulging, if you like, in a central bank's version of a crackup boom, which for people who don't understand what it is, I mean, this was something that the economist Ludwig von Mises wrote about because he experienced the demise of the Austrian shilling and also observed the demise of it was the Austrian crown in those days. He also evidenced the hyperinflation in Germany, which lagged the Austrian one just slightly. And he observed that in around about the last 5 or 6 months of this, this collapse of the currency, people suddenly realized that it wasn't prices rising, but the currency going down. Now, the moment they realized that, they dumped the currency for anything, just to get rid of it. They bought anything, even if they didn't need it. They just wanted to get rid of wheelbarrow loads of this rubbish. And that's precisely what China is doing.
But I believe China is the #1 gold producer and the #2 silver producer in the world. So while a lot of people are paying attention to the import-exports, is China officially reporting all of the silver and gold that they're mining? And how much of that do you think they're taking into their own reserves as opposed to exporting to other countries?
Well, I mean, the answer, I've always maintained that with respect to gold, China is like Hotel California. You know, you're welcome to come in, gold ingots, but you ain't leaving, if you see what I mean.
History shows currency confidence usually breaks suddenly, not gradually. This is where Alasdair Macleod's thesis shifts from commodity prices toward declining purchasing power as the real story. Whether that historical comparison ultimately proves accurate or not, governments accumulating tangible assets deserve careful attention. Investors should focus on preserving long-term purchasing power instead of chasing nominal returns alone. Next, Alasdair Macleod exposes why China's domestic gold policy may matter more than global mine production.
So on that basis, it's really, anything that she's mined, she has kept. So you can add that, if you like, to the balance of, exports, imports. I mean, there have never been any exports. But interestingly, in the last week or two, it's become evident that that is changing. What happened is that the People's Bank of China issued a note saying you no longer need to ask our permission, the central bank's permission to export gold. It's just a customs matter. What that means is that people owning gold in China can send it from China to Hong Kong as part of this new market. I suppose they can send it anywhere, but it's still got to go through customs. So I guess that they'll probably restrict it to this new Hong Kong, if you like, market development. So you've now got freedom of movement in gold between the Shanghai Gold Exchange and the new Hong Kong market. So that is a big, big change. And that's happened literally in the last 10 days or so.
Yeah, I want to touch on that because Hong Kong has launched a new gold clearing and settlement system, at least 6 major banks signing on, including JP Morgan, Deutsche Bank, and many others. Hong Kong's chief executive, John Lee Ka-chiu, stated, "The launch of Hong Kong's central clearing system for gold will create a historic foundation, allowing us to take the next major step, and that's building a comprehensive gold trading ecosystem."
Major market shifts often begin with infrastructure changes that receive little mainstream attention. Alasdair Macleod notes expanded gold movement between mainland China and Hong Kong could reshape regional liquidity over time. Clearing systems rarely attract headlines, yet they influence where capital ultimately settles. Investors watching only daily price charts may overlook the significance of evolving financial architecture. Next, Alasdair Macleod reveals why Hong Kong's new gold ecosystem challenges the traditional Western trading framework.
If gold is the world's safe haven, Hong Kong will be its safe harbor. Very interesting development. What do you think it means for the global gold market as well as the gold market within China? You've alluded to it, but would love to get some more thoughts from you.
Yeah, it's quite simple. You've got to look at this in connection with earlier moves that the People's Bank and the SGE have done. Bear in mind, the SGE is owned and run by the People's Bank. So, when we talk about the People's Bank and the SGE, we're really talking about one organization. What they did was they opened a vault in Hong Kong, which was an exchange facility, if you like, for gold for Chinese yuan or Chinese yuan for gold for anyone. And it all fits in with the new payment system, the SIPS payment system, which they've put together. And they've also, interestingly, been opening another vault in Saudi Arabia. And there's talk about these vaults new vaults being opened in Southeast Asia. There was stories that they would probably open one in Dubai, though events have rather overtaken that. And there was even mention, and I think it was probably a bit speculative, that they would open one in Zurich. I mean, the point is that right from the outset, China realized that fiat currencies never, ever survive. She was emerging from the Mao era into a world of fiat currencies.
Infrastructure often reveals strategic intentions long before policy speeches do. According to Alasdair Macleod, expanding vault networks and settlement systems indicates preparation for broader bullion flows beyond traditional Western channels. Whether these initiatives transform global pricing remains uncertain, but they signal long-term planning rather than short-term speculation. Investors should pay attention when institutions build systems before demand fully materializes. Next, Alasdair Macleod exposes why these vault expansions may matter more than another central bank press conference.
They weren't going to survive. So what she had to do was to play the fiat currency game, but never forget she needed to protect herself against their collapse. And this has been her policy the whole way through. She, between 1983, when the People's Bank was appointed with responsibility for the entire nation's gold and silver reserves, I'm not talking about bank reserves, but ownership of gold wherever. 1983, she started accumulating gold in that big bear market. I reckoned, and I did some calculations, it was very much a back of the envelope type calculations, but I reckoned that at contemporary prices, she probably accumulated around about 20,000 tons by 2002. The reason 2002 matters is that the Shanghai Gold Exchange opened, and for the first time, citizens in China were allowed to own gold. And indeed, I think 4 or 5 years later, the Chinese government even advertised, they did television adverts, buy gold, it's good for you, whatever the strapline was. So you can see that there's been a deliberate policy here. They've also, as you alluded earlier, they accelerated mine production very, very significantly, to the point where they rapidly overtook South Africa, which admittedly was declining in its output, and has been the world's largest gold output, miner, if you like, by output for, I can't remember when the crossover was, something like 2007, 2008. So that's been, almost 20 years she's been the largest mining nation.
Long-term strategy is often invisible because markets reward quarterly thinking instead. What Alasdair Macleod is highlighting is a decades-long policy framework rather than a reaction to recent economic uncertainty. Even if individual estimates are debated, sustained investment in production and market infrastructure reflects deliberate planning. Investors should distinguish temporary headlines from structural trends. Next, Alasdair Macleod unravels where decades of physical gold may have quietly accumulated beyond public attention.
And then we have seen this continual migration of physical gold from Western capital markets into China, never to return. So my guess is that she's probably, as the state accumulated a further 20, maybe 25,000 tons. Of course, you've also got the deliveries out of the Shanghai Gold Exchange, most of which has gone into jewellery, admittedly, into the hands of the public. That is a further 28,000 tons. We don't have scrappage figures, but anything that's scrapped has gone back into the SGE, vaulting system, and would have, it hasn't left the country.
Physical metal moving east while financial markets remain focused on paper assets creates an overlooked divergence. Alasdair Macleod's argument suggests cumulative bullion flows deserve more attention than short-term price fluctuations. Precise reserve estimates remain uncertain, but persistent accumulation raises important questions about future monetary confidence. Long-term investors benefit from watching where physical ownership concentrates.